Philippine Accounting Standard 7 entitled Statement of Cash Flows. Basically, we will be discussing here is the inflow and outflow of cash. So here's the learning objectives. First is to describe the statement of cash flows. Next is to differentiate the classification of cash flows such as operating activities, investing activities, and financing activities. And next is to state the classification of interest and dividends. What is statement of cash flows? Statement of cash flows is one of the components of financial statements, and it is the integral part of its primary financial statements. And it also summarizes the amount of cash and cash equivalents entering and leaving a company. Definition of terms. We will define the terms under the statement of cash flows. Cash, it comprises cash in hand and cash in bank. Cash equivalents, these are short terms, highly liquid investment that are readily convertible to known amounts of cash. In short, it will not matter the time of the period of your cash equivalents or your investments if you purchase within 3 months before the maturity. Cash flows, it includes inflows and outflows of cash and cash equivalents.
Classification of cash flows: operating activities, investing activities, and financing activities. Statement of cash flow being presented. It should be reported during the period classified by operating, investing, and financing activities and provides information to allow users assess the financial position and amount of cash and cash equivalents, and it has two methods, direct and indirect method. Operating activities. In past 7, paragraph 15 provides that cash flow arising from the purchase and sale of dealing or trading securities, and it shows you how much cash is generated with the actual operation of the business. Example, cash payments to supplier for goods and services.
Investing activities include cash flows from transactions involving on operating assets. It shows how a company is allocating cash for the long term. For instance, a company may invest in fixed assets such as a property, plant, and equipment to grow the business. And for example, cash flow from investing activities is a sale of investment by non-financial enterprise. Financing activities. Finance activities include the issuance and repayment of equity, payment of dividends, issuance and repayment of debt, and capital lease obligation. For example, cash receipt from issuing shares or other equity instruments, cash repayments to owners to acquire and redeem the enterprise shares.
Operating activities. It shows you how much cash is generated with the actual operation of the business by selling the company's product and services. Investing activities. These are cash spent on investment or cash received from sales of investment. It outside the primary business activity of selling products and services. Financing activities summarizes cash transactions that involve raising, borrowing, and repaying of capital. Exclude is do not require cash or cash equivalent. Include is when it can affect your cash or cash equivalent. Interest income received. An income occurs when you receive interest income. Therefore, it is an operating activity. When you receive interest income, meaning you let them borrow your money or have an investment, it could therefore be an investing activity. Interest expense paid. It could be an operating activity because operating activity includes cash inflows and outflows on items of income and expenses. It can also be an indication of borrowings. Therefore, it could be also included in financing activity. Dividend income received. You get dividend income because you have an investment. So it could be an investing activity. Or it could be a revenue. So it could be an operating activity. Dividend paid to owner. These are payment owners. Therefore, financing activity. It can be an operating activity because it could be a determination of profit or loss.
Now, I'm going to discuss about the difference between the direct and indirect method for preparing the statement of cash flows. The investing and financing activity are the same. It doesn't matter what you use. While the operating activity use direct or indirect method, but the difference is how the operating activity is prepared. So operating activity for the sample company, we have a comparative balance sheet and income statement. These are the numbers that being used to prepare the statement of cash flows. For the direct method, what we are doing this, we're gonna go to the income statement. We take all items in the income statement one by one. We're going to convert it to cash basis, but the depreciation expense does not appear on a cash basis because it's a non-cash charge. You wouldn't see it in the direct method. On the other hand, indirect method is what most commonly used. We're gonna start on the net income from the income statement, and then the rest of the operating sections will undergo adjustments to reconcile the net income to cash flow of operating activities. We start on 32,000 of net income, then look for the current asset and current liabilities from the comparative balance sheet. We also have a non-cash charge like depreciation expense. This depreciation expense reduces net income. Before thinking this depreciation expense is not in the net income, we better add back the depreciation expense added to the net income. Direct method uses actual cash inflows and outflows from the company's operations instead of modifying the operating sections from accrual accounting to a cash basis. And indirect method, the non-cash items must be added back to reconcile the net income to actual cash flows from operations. PAS 7, Statement of Cash Flows, encourages to use of direct method, but in real practice, they use indirect method because it is much simpler and most companies keep their records on an accrual basis.